If you're overwhelmed with stock research, you're spending hours reading news, analyst reports, scrolling Twitter, looking at price charts, you're not alone. Whether you're an independent investor who wants to manage your own portfolio or a professional that's trying to get your PMs to listen to you, you've probably faced this problem, which is, what do I actually need to read to make a good decision and make money with a stock that I pick? See, the problem is you've probably been taught a lot of information, but never anything real that helps you make a decision. If you studied formally finance, you've probably learned things like free cash flow to equity or a whole bunch of other finance calculations, but you don't actually know what a stock is worth. Or if you come from the trading world, you're taught to look at price charts all day, look for things like support or resistance or trend lines, but you don't really know what a business is worth either. And even if you left that world, every day now you're going to have to sort out between all these gurus online that are pitching these stocks like this is some life-changing opportunity, but you also, again, have no idea if this stock is going to be worth something or it's just some kind of pump and dump that's just going to crash later. So today I'm going to give you a framework that's been honed from working close to 10 years in professional equity research at an investment bank. And so here it goes. So before you go and waste more time on research, really think about, there's just 5 things you must answer. And this is the business model framework that we teach at the Stock Investor Accelerator. So the purpose of all of this is, well, we want to buy a stock and we want it to go up, right? Right? So it all comes down to, is this company going to make money, or earnings, we call it, or cash flow? And what kind of returns can I get as an investor? So you want to see the earnings go up and you want to see the returns go up. That makes that asset or that stock become more valuable. So that's the point of our research. We need to understand, how does this company make money? So here's what I want you to do. Take the annual report of the company. So download it, and then you're going to want to answer some of these questions. Now, I just did this research on Sprouts. It's a grocery store, so I'm going to be showing a lot of this as an example. Okay, step 1, crack open that 10K. Now, I know you'll want to scroll on Twitter or check Instagram or whatever it is, but I need you to close all your applications. Close your browser tabs, put away your phone. You're going to actually need to think. Well, of course, unless you're watching it on your phone, but put away everything else. And don't ask AI what about the company, or read an analyst report or some newsletter writer on the stock. Why? Because you want to read something objective, right? You don't want someone else's opinion because you want to make your own determination, right? That's the whole point. You want to make your own decisions. So first, read this one section. It's called the business overview. I want you to put all your distractions away, read the whole thing, Google any words you don't understand. There's going to be some industry lingo in there, most likely, and then come back. Now, once you've done that, ask yourself 2 questions. Who is the customer and what do they sell for money? That's it. Boom. Now you understand how this business actually makes sales. So everything's going to flow from there. Now, step 2. Now I want you to go to the management discussion and analysis section. So now here we're going to actually research how the business works. And so what you're going to see here is the management's commentary of what's going on with the business. So again, I want you to shut off everything, remove your distractions, kick your cat out of the room. And now this time, before you read, I want you to pay attention to just 2 things. First is the cost of sales. It's a line item that they're going to talk about. And 2 are the other costs of the business. Those will be things like sales, general, and administrative expenses and research expenses. So what I want you to do is read through that and note down the costs of the business. So now go ahead and read through this section, write down your notes, and then come back. Okay, so now let's talk about what these things actually mean. So the first thing is the cost of sales. So this is what we call unit economics, which is the cost of making and selling the product. That's the first cost input of a business. So I want you to just think, you can pause and just summarize what that actually is. Now, second, the other cost items that you noted down, these would be considered the operational costs, things like research, marketing, sales. These are all the costs to operate the business. And usually they're typically labor expenses and selling expenses. So we split them up because we want to know the cost of the product or service and the cost of the business separately. Because if the business can't make money on its own product alone, that business ain't ever going to work. So now you have these pieces. I want you to also just stop right here, just summarize all the major costs for the business. So now we have all the pieces now to think about the profits of the business, right? Let's think about our sales. You can go back and just get the sales number minus the cost of sales number. That'll equal what they call gross profits, right? That's the profits of the product itself. Now we take the gross profits and then we minus all the other operating costs, and that'll get you operating profits. So the operating profits is now the money that the business has made after all of its business costs. It's these profits that are important because profits make us money as owners. Okay, so now step 3. Let's do a little analysis. So there's something called margins. What you want to do is take the gross profit as a percentage of revenues. So gross profit divided by revenues, that'll equal the gross margins. Do the same with the operating profit as a percentage of revenues. That'll tell you the operating margin. Now, margins tell us how profitable the business is. Now, here's what I want you to do. Either calculate it yourself using the numbers you have from the 10K, or I want you to pull up something like Koifin, or you can just use the 10K, or use Yahoo Finance. I don't care. Just get the margins, and then I want you to look at the change in gross margins and the change in operating margins from last year to this year. Work those out or find those, and then come back, and we're going to talk about what that means. Okay, so higher gross margins means the company is making more profits on its product. Now, that's what we usually call scale, meaning the business is becoming more profitable selling its own stuff. The second thing is if you see higher operating margins, now that means the business is becoming more profitable, making more profits as a business. That typically means it's using its costs more efficiently. So you can look into the individual line items later and look at, say, if the sales as a percentage of revenues is declining or it's lower, that means that its sales force is becoming more efficient. It's selling more of its product per salesperson. Now that's called leverage. So you know that Greek philosopher who said, give me a lever and I'll move the world? In finance, it's the equivalent of give me enough leverage and I'll make you f***ing rich. Something like that. So you get scale and you get leverage, that equals more profits for the business. And those are the two components of what makes a business a lot of money after getting its sales. So now you should have an inkling of how this business makes money and whether it's getting better at it. If it's not making money or getting better at it and it's getting worse, you should probably move on. Unless, of course, you're doing a value strategy, which is buying something super cheap. But that's a different story. We'll talk about that later. For now, we're keeping it simple and looking for companies that are going to make us money on its own. Okay, step 4. Now, this ties everything together. You know how there's companies like Costco? It's a great company. A lot of people love shopping there. If you're not in the US, it's basically the most American way to shop. You buy a ton of stuff at super cheap prices. But I digress. There's a reason to why this company trades at a super high valuation ratio. Right now, it's 50 times earnings. So 50 times the value of the company is 50 times its actual profits. Meaning this company is more valuable than Microsoft. Now, the key thing here and why Costco is so richly valued is because of the returns. So now in this step, we're going to jump back into the financial statements. And I want you to first look for 2 things for the company. 1, is there any debt? And 2, just make a note if that's going up. You can just write them down. Look in the balance sheet in the liabilities section. Now, second, I want you to look at the equity section. Look for something called additional paid-in capital. Now, I want you to make a note of that number, whether it's going up or not, and also make a note of the total equity and whether that's going up or not. You can just write down all these numbers just so you can reference. Now, here we're going to start to do a little bit of calculations. I want you to add up the debt and the equity together. And when you put those together, that's the capital that the business has used. So you can think of that as all the money that's been invested into the company. Now, the second thing, once you got that down, I want you to look at the operating profit. So take the operating profit if you have it handy already. If not, go to the income statement line. And what I want you to do is just take off the tax. So it's operating profit minus tax. Okay, so if you're a purist, technically what you should do is just apply its tax rate. So operating profit multiplied by the 1 minus tax rate. But for now, just to keep it simple, just take away the actual tax number. Now we have the operating profit after tax. Now, what you want to do is divide that by the total capital. So operating profit divided by total capital. That will tell you the return on invested capital, meaning what return is the business making on all the capital that's been invested into it. So it's essentially just profit as a percentage of that capital. Now, this may not be intuitive to you if you haven't been taught this way, but it's actually really simple. When a business makes lots of money with very minimal capital, that's a great business. Like if I gave you $1 and tomorrow you made me $100 or I made you $100, we're freaking geniuses, right? Everyone's going to want to give us money. And so that's the same thing that happens to companies. When it makes a lot of money on its capital, people want to own it because it's making a lot of money. It's a very valuable business. Now, the reason why that is because that business, they can give it back to you. If they can use that profit to, or use those returns to pay us with a dividend or maybe buy back shares, or it just means they have a lot of capital to invest, right? And that's an advantage as well. So look at the numbers that you have. If the profits are growing faster than the capital, well, you got a business that has rising returns. Now, that likely means the valuation of that company will also rise. The stock will go up. Now, if you see the opposite, say if there's tons of additional paid-in capital, meaning they've raised a lot of shares, and there's no profits, or worse, there's more losses, well, that's a company that's destroying capital. That stock's going to go down. So once you do all these steps, you know by now how the business works. You know how it gets sales, you know what are its costs, and you have a sense of its profits and its returns on its capital. You already got a decent sense of how this business works in your head, right? The next step from an investing perspective is just projecting that out forward, imagining or forecasting how it will evolve. Now, if it's going to have more earnings and higher returns, that's going to be a more valuable stock. So if you're looking at stocks to make money, obviously, as an investor, you're really looking for a stock that'll go up. Duh. But in other words, you're looking for a business that's becoming more valuable. So what are you really researching? You're trying to understand whether this business is becoming more valuable, which really comes down to, will it make more earnings? Will it make more money? And will it generate good returns? So at the end of the day, to be a good investor, a great investor, means you're going to be doing research like this to really figure out, is this a good business? And you do it enough times, you're going to start to develop an eye for it. And that's going to be how you outperform with your picks and make money. Thank you for watching.